Hello and welcome to Raise Your Average. I'm Pierre Daly, managing editor at advisoranalyst.com. My co-hosts are Adam Butler and Michael Philbrick from Resolve Asset Management Global. Our super special guests today are David Blanchett and Michael Finke. David is the head of retirement research at PGIM, an asset management unit of Prudential, and Michael is a professor of wealth management at the American College of Financial Services. Today, we're going to be talking about new approaches to optimizing retirement.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
David, Michael, welcome to the show. It's really exciting to have you.
Thank you.
I'm happy to be here. Michael as well, right?
Oh, yeah, reluctantly, but yes, happy to be here.
Well, guys, thank you.
So, gentlemen,
go ahead.
Go ahead,
Well,
Michael.
I
Sorry.
just wanted to say thanks for joining us. You guys are an absolute fountain of knowledge in an area that I think is largely undercommunicated, to some degree miscommunicated in the financial services business, and I'm looking forward to peeling back the onion with you guys today.
Yeah, I have to add, there's a real dearth of what you have to offer in terms of knowledge out there, and there's a real proliferation of nonstop optimism. So let's get to it.
Well, you know what happens when you peel the onion, right? There's always tears.
Oh, that's
so
good.
let them flow.
So, David, Michael, to kick things off, please give us the rundown, the stories of your respective careers, a little bit about where you are now and what you're working on.
David, you have a far more interesting career. Why don't you go first?
I don't know about that. I mean, so these days I'm the head of retirement research for PGIM DC Solutions, the new unit within PGIM, focused on the DC space. Those who don't know who PGIM is, it's the investment management group for Prudential. I just left Morningstar. I was there for about 10 years doing the same thing. As I go further back, I used to be a financial advisor, different stuff. I've always been fascinated by the field of financial planning and helping people accomplish financial goals. So, Michael?
Yeah, I started out as the head of the Ph.D. program at the biggest financial planning program in the United States. That was Texas Tech back in 2006. And I'm trained as an economist, so I understand the value of annuitization as part of retirement income planning. I teach it in the Ph.D. classes. And part of the challenge of being in this field is explaining to financial advisors, many of whom are resistant to the idea of using guaranteed income, that this actually is an option, that we have understood in the field of economics for a long time, that annuitization is a way of getting rid of a very important risk in retirement. That's the risk of not knowing how long you're going to live. That's an idiosyncratic risk. And the foundations of finance say that if you have an idiosyncratic risk, you should try to get rid of it. You should try to pool it with others. And a part of what David and I, and also our co-author Wade Pfau, have done over the last decade is talk about, first of all, how some of the assumptions that financial planners use can be overly optimistic. For example, at the very basic level, asset returns on bonds. We know returns on bonds are not going to be as high as they've been historically. So we can't really use historical returns to be able to identify what is a safe practice for creating income in retirement. And part of what we're trying to do is show that annuitization can be a more attractive way for retirees to actually spend their money, especially the money that they've got invested in safe types of assets like bonds. So we have been working on this for about the last decade, different permutations of the use of guaranteed income, when it makes sense and when it doesn't. We feel pretty comfortable that financial advisors in general don't use it enough.
Michael just goes straight to annuities. It's like his go-to out of the bat.
It is, yeah.
And why do you think that
bury
is?
the lead,
Mike?
or
I mean, is it
Just start there.
is it the cynical view that either they're not educated enough or they just don't pay enough commission?
Well, in the United States, we have very different camps of financial advisors. We have those who are paid by commission and those who are paid by assets. And those who are paid by assets don't have a very strong incentive to encourage their client to annuitize a portion of their savings, because essentially that's giving away part of their income. And on the other hand, you have those who are incentivized by commissions, and sometimes they sell products that pay a higher commission, even if they're not necessarily the best products for the client. And that's created a negative reputation, I think, of the sales practices and even of the product. It's really tarnished the image of the product. So we really are focused on how to use these products efficiently and what types of products make the most sense. But I think that there's a lot of reasons why annuities, and I think a lot of advisors simply dismiss annuities offhand because of perhaps some of that negative reputation and the historical sales practices. It gives them license to feel like they can comfortably dismiss these products, when the reality is that it's just a tool in the toolbox, and they have to consider using the tool when there is an appropriate job for it.
Yeah.
I think that's my biggest beef that Michael just touched on, is the fact that too many advisors just don't even consider them, right? I totally get that, and again, in the US, delaying Social Security is like the best place to go to for guaranteed income. But, I just view them as one of many, clubs you can use when you're playing a game of golf. And the more clubs you have, the better you're going to play. And I just feel like, I like to poke the bear every now and then on LinkedIn. You have someone kind of, say negative stuff about things, and and the arguments, I just don't hear compelling arguments why they shouldn't be used. I hear people talk about fees and about bad products. And my response is like, you have specific human capital. You are trained to help your clients accomplish their financial goals. You can sort through thousands of mutual funds and ETFs and pick 6 for a portfolio. You mean to tell me you can't, sift through all of the different, policies out there and pick one that might work for some of your clients? To me, it just suggests that they're not really trying.
Well, I think it's important too to recognize that the Canadian landscape for annuities is quite a bit different than the American landscape, right? So this podcast is primarily directed at Canadian investors and advisors. So a lot of the more like the different types of deferred and variable annuities that you could get in the US are just not typically available in Canada for average investors. So there's a bit of a more limited offering on that side. Interestingly, just in the last year, some new products have come to market to help try to fill the gap. Specifically, there's a purpose vehicle that was launched this year, modeled somewhat after a variable annuity and has some of the other characteristics about a tontine. Maybe it's a little earlier the conversation for this, but since we did start with annuities, maybe for the benefit of our Canadian audience, maybe can one of you talk about what you understand about this new product and some of its positive and negative features?
Yeah, I mean, I can have a quick go at it. I mean, if you think about an annuity, historically, there's been, a government or more recently like an insurance company behind it. I mean, this is effectively purely an investment vehicle where the investment and mortality experience is shared among, the shareholders, whatever word you want to use to describe those that own into this product. And so it's not necessarily a new way to do risk transfer. It's been around for hundreds of years, but what's interesting is that we don't really have a tontine-esque approach available in the US. And so I think that, it really is an exciting innovation in terms of product availability for Canadians looking for something that can give them a way to kind of protect their lifetime income, but in a different way than you would with an annuity. Now, there are, pros and cons we can talk about, but, I tip my hat to Canada for being a leader in that space.
Well, there's 2 primary sources of risk for retirees. There's more than 2, but certainly there's market risk and there's longevity risk.
Right.
And so maybe talk about how traditional annuities address both of those risks and maybe contrast that against how this new purpose vehicle approaches it.
Michael?
Well, I'll start with longevity risk, and I'll try to make it as simple as possible. So,
is this the cake metaphor?
We're talking about cake.
Exactly. You've got to use the cake metaphor. So
yes. Okay.
Yeah.
But I think it's so important to understand, why is this important? What happens in the absence of being able to share that longevity risk with other participants in a pool. So we have, say, 100 retirees, and all of the retirees have their own accounts, and they try to spend down their accounts every year to provide a lifestyle for themselves in retirement. The problem is that they don't know if retirement is going to last 10 years or 20 years or 30 years. So what do? Do you assume that retirement is going to last as long as your expected longevity? Well, that means that if you spend according to your expected longevity, 50% of the chance, 50% of the time you're going to run out of money because you're going to outlive your expected longevity. Now, you can choose a percentage failure rate. So you can choose a age that you want to spread your assets across that is equivalent to the 25th percentile of longevity. So let's say you're a healthy 65-year-old woman. The 25th percentile is somewhere around the age of 95. So you take your investments and you spread them to the age of 95. Well, there's still a 25%.
So let's just make sure everyone understands. So in this context, 25th percentile means you have a 25% chance of living past this age.
That's
right.
That's correct. It probably makes more sense if I say the 75th percentile. So 25% chance of failure. Then you spread your assets to the age of 95. So maybe you can only accept, say, a 9% chance of failure, in which case you spread your assets to the age of 100. Well, this creates a problem because, first of all, it exposes you to the possibility that you're going to run out if you live beyond the age of 100. 9 out of 100 women who are healthy at the age of 65 are going to live beyond the age of 100. So they will be unhappy because they have run out of money. The other 90% of women could have spent more. Half of them are going to die sometime before the median longevity. They could have spent more every year, but instead they were scrimping so that the money could last to the age of 100. So what would happen if we all got together and created a long life income club where everybody pools their money together and then we can all spend as if we're going to live as long as the average person in the pool? And some of them are going to die before the average longevity, but they spend more every single year that they were alive. So even if they only lived 10 years, they lived better during those 10 years because they spent more each year. And they also knew they were never going to run out. So they could comfortably spend that money. They didn't have to have worry hanging over their head that if they went on vacation, like they might be jeopardizing their ability to live when they're in their 90s. So we could all get rid of that longevity risk by creating a club. We pool our money together. What eventually is going to happen is that those who die early are going to subsidize those who live a long time. But those who died early, they're dead. So they don't care. They are subsidizing someone else, but it doesn't matter to them because every year that they were alive, they lived better. So that's the basic intuition behind the value of annuitization, is that by pooling our assets together as a group, we can all collectively live better and spend more and not live with the fear that we could potentially run out. Now, if we don't annuitize and then we back out optimal spending, what we see is that optimally we will spend less each year because we are all risk averse. And because we're risk averse, we fear that possibility that we could be in a situation where we outlive our savings and we have to spend significantly less later on in retirement. So that's the longevity risk. And that's why it's efficient to pool that together with other retirees. You can actually live better with less risk. David, you want to talk about asset return risk?
Yeah, I mean, asset return risk is that if when you retire and your assets go down, you have less money to fund your retirement with. It's simply that bad markets, especially when you first retire, have a pronounced negative effect on the ability of that portfolio to generate income for longer time periods. I mean, you can run all these scenarios and you can have the exact same geometric return or arithmetic return, but what matters if you get that negative 40%, that happens in year 30, you're going to be fine. But if it happens in year 1 or 2, it can be disastrous. And so that's this risk that is, very difficult, so much longevity risk that you just have based upon how you invest and what you purchase in terms of funding your retirement.
Yeah. So that's a really important point, right? Because market risk is kind of a combination of two different types of risk. One is the risk that the drift term, in other words, your actual realized compound return is lower than expectations. But the other side of that is that the sequence of those returns is disastrous to your spending plan, because you have an extremely bad period of returns early on when the size of your nest egg is very large, right? So the order in which those returns arrive actually has a really meaningful impact on the sustainability of your nest egg, right? So really it's kind of three distinct sources of risk. And this purpose product is designed really to pool longevity risk so that everybody can plan their spending based on an expectation of living to their actual expected, average mortality. So let's say for a healthy 65-year-old woman, what is that? 87, 90? Instead of having everybody have to plan for their, 90th percentile or 95th percentile, longevity, which may be, as you say, sort of, upwards of 100 years, right? So everybody, by sharing this longevity risk, everybody gets to have more certainty in their planning and has an opportunity to spend more in retirement and live a more robust lifestyle. Did I get all that right?
You did. I mean, so one thing, there is certainty, but there's also uncertainty, right? So, there's lots of different ways you can create, this is maybe a bit of a nuance, but guaranteed or protected lifetime income, right? So it's an interesting component of a tontine. And I'm a huge fan. Don't let my comments be otherwise, but what it kind of hinges on is that you get the estimates of that tail risk correct, right? So if people collectively start living a few years longer than average, that can have really big implications for those who are actually alive at age, 100, 105, where they could see these large unexpected changes in income based upon, how you cohort out the different groups and everything else. So, I mean, I think that to me, it just exists on a spectrum, right? If you kind of think about like the most basic product, you've got like these immediate annuities where you have this irrevocable transfer of wealth and you get income for life, and it's that easy. On the other end of the spectrum, you've got tontines, where you've got this kind of, collective investment in mortality risk. And then I think that in reality, for most folks, they should use both, either some combination of the two or other products that do combinations of those attributes based upon what they're trying to accomplish.
Yeah. So I guess you can, if you were to combine a tontine with a longevity swap,
yep,
then now you're finally able to hedge the longevity risk completely. But the tontine itself is vulnerable to just a general upward shift in average lifespan over the term of the tontine. Yeah,
so that's actually where we are in America right now. So America, we have products that do allow for that kind of, investment experience will affect your results, but not really where there's that sharing of the mortality experience. And there's pros and cons to each. I mean, if you can cut out the insurance company, in theory, you can have higher payouts, but it does create more uncertainty at the tail end where, if there is that breakthrough in cancer and all of a sudden people start living longer, it could be disastrous for the 10 that are left as part of that pool.
Right. Well, I mean, the insurance companies are short that risk, right? So it's possible in the end that the insurance industry itself is unable to meet those guarantees in the end.
They have other so like if you look at the purpose structure, they use cohorts, right? Where they've got, I forget if it's 3 or 5 year groups, where it's not, because you do worry about intergenerational transfers to some extent, right? So like, you don't want to necessarily, public pensions, that's going to happen because you're pulling resources across 50, 75 years. If you have a more segmented approach, certain cohorts could be a lot more effective than others. And so, a benefit or a problem with insurance companies is that it's all one giant pool. So it's true that they would be negatively affected, but it wouldn't be as much as, if you have just a group of, like of the 90 to 95-year-olds and there is that, is that change, then that group would be affected a lot more than the more kind of like generalized pooled structure.
Gotcha. Sorry, Michael, I cut you off twice. Did you have something you wanted to add?
Well, I mean, it's first of all, with an insurance company, oftentimes they have a significant amount of life insurance on the book. So a big shift in longevity is actually going to be good for them, for that part of the book that is associated with their life insurance business.
Great point.
That's going to make it easier for them to withstand a potential improvement in longevity. Whereas if you hadn't transferred that risk to an institution, such as an insurance company through a tontine, you could buy a longevity swap, but there is some benefit that transferring that risk, that pooled longevity risk to an institution can provide relative to a tontine.
Yep. No, that makes sense.
And I guess I agree completely with the hedging component of like life insurance and annuities, but the actual hedge varies a lot based upon each insurance company. So, I mean, those that, for example, have more whole life insurance are going to be a better hedge than those that focus just on term. But that is a structural hedge that does exist within insurers versus, say, a tontine, which is just kind of focused on that longevity piece.
Got it. So maybe let's turn to a discussion of market risk, because I think this is a source of risk that is maybe profoundly underappreciated at this point in the cycle. So maybe Michael, I don't know if you want to kick off, but maybe give us your capital market expectations or where you think people should begin to start thinking about planning in terms of expected returns for traditional portfolios going forward from this point.
Well, Adam, I think you and I agree that everything is expensive right now. So all financial assets, generally speaking, are historically expensive relative to their average as a multiple of the profitability of the company. And that historically, when they've been expensive, the returns on those assets have been lower than they have been historically. So I think it's a big danger to use historical data that includes returns from periods where stocks and bonds were cheaper than they are right now. When we look at those periods that stocks and bonds are as expensive as they are right now, what we see is that we cannot hold the same return expectation. So probably as we know what bond returns are going to be within a relatively tight range based on yields today. We don't know what stock returns are going to be, but they're a lot more expensive than the historical average. In the United States, they're more than twice as expensive as the historical average. In periods where they've been that expensive, and in fact, you can actually create a model that would lead you to believe that the expectation of 10-year returns is probably closer to about 2 or 3% on average. Now, that's on average, which means that you have this whole normal distribution with maybe 2% in the middle, and then all these tails going off in the right and left-hand side. So maybe returns could be 15%, but maybe they could be negative 15, or maybe they could be negative 20%. And the problem, especially for near retirees, is let's say you have a 5-year time horizon and you've got this investment portfolio, which is a normal distribution, and you're going to be investing in it over a 5-year time horizon, and then you're going to retire. Now, there is going to be a relatively wide distribution of incomes that you could draw from that portfolio 5 years in the future. And if you look at a normal distribution, what you see is that, you on average, you might be able to generate $25,000 of income, but at the first percentile, maybe it's $10,000 of income. And at the 99th percentile, maybe it's $60,000 of income. You're going to be somewhere in between there. You're probably going to be close to the middle, but you don't know in advance. And I think that makes it very difficult to plan for a lifestyle in the future, especially if you're investing in highly risky assets. So a lot of people right now look at yields on bonds and they say, whoa, those are too low. The only option I have is to go heavy into investment risk. But when you go heavy into investment risk, you have to accept that distribution of outcomes, which means the distribution of your lifestyle in retirement, is going to be broader. And can you handle that? I mean, if you look at the left tail and you look at what your lifestyle could look like on the worst part of the distribution, can you live with that? And then you have to ask yourself, if you can't, is it worth taking all that risk? And the only reason you take the risk is so that you can get the best case scenarios. Would you trade some of the best case scenarios for some of the worst case scenarios? If you would, then it might be worth thinking about how to constrain that distribution somehow, either by taking less investment risk or through the use of products that incorporate financial options.
Is there a case for nominal bond exposure in the portfolio instead of, like, how should people think about a nominal bond ladder in the portfolio versus a simple annuity in the portfolio? Like, are those generally substitutable, do you think? And then if so, how should they think about the relative merits?
So I would say kind of, right? I think there's a problem with how we think about risk as it applies to goals, right? So, if I ask people, like, what is a safe asset, a really safe asset, you would say, well, cash is a safe asset, right? Because cash, T-bills, the odds of you not getting your money back in 90 days are like zero, right? Well, I mean, how safe is cash to own for 30 years if you're trying to fund a retirement goal? It's not very safe, right? I can tell you with a high level of certainty, if you own cash and it stays at today's yields, you're not going to have income last more than 20 or 25 years at a decent withdrawal amount, right? And so there's this question of, well, what does it mean to be safe? So nominal bonds are they're somewhere in between, right? Obviously, if you have a 10-year government bond, it's not as safe as cash, and there's more volatility there if you're market to market, but it will do a better job of funding income in retirement, right? Annuities, though, are different in that they're cash-like in the volatility of the income. It's guaranteed, but it also then hedges away that longevity risk. And so I think that the perspective we take on risk depends on what we're trying to do. And I think that nominal bonds, definitely have a place in the portfolio. But I mean, as kind of Michael's alluded to already, annuities or just guaranteed income in some capacity becomes more and more efficient, where you're looking at to use it to kind of, minimize risk when it comes to funding that retirement income.
Yeah, I think you have to think in terms of every asset having a goal. And the first step in the retirement planning process is, what are your goals? So the basic fundamental goals are, how much do you want to pass on? What is your legacy goal? What is your income goal? And along with what your income goal is, how much variability are you willing to accept in terms of your lifestyle? And investment risk means variability in your lifestyle, but also accepting longevity risk means variability potentially in your lifestyle rather than transferring that risk to an institution. So, when you say bonds, like, what role does a bond have in a retirement portfolio? If you have no legacy goal, then an economist would say, other than the need for emergency liquidity, there's no need to have bonds in a portfolio, because you can always generate more income per dollar through annuitization than you can through bonds. So why hold them? There is an opportunity cost. Now, the opportunity cost might be worth it if you want to maintain a certain amount of liquidity for emergency needs. But if you don't, or if you can tap some sort of a source for liquidity, like, for example, home equity, then it really doesn't make sense. You will lose every year by creating a bond ladder versus annuitizing.
Well, I think the legacy issue is a big issue, though. And probably one of the largest challenges that I think individuals face, and maybe advisors don't discourage enough or don't educate enough around, right? The fact that, if you this is not a 0 or 1 conversation, obviously, right? So in the context of, you have no legacy thought, great, right? So maximum annuity, get the income in, away you go. You may change your mind, but it's that fear, I think, that drives a lot of the decision making around. I don't know. I think I'm going to die tomorrow.
So, but I mean, so I think that the people have the wrong perspective there. So I think what you should focus on is some kind of like minimum threshold. So I always make the point that, let's say that you're making a decision to buy an annuity and you're worried about, I'm going to die when I'm 70 years old. Okay. Here's the kicker there. If you die when you're 70, your kids get all the money that you save for retirement. Congratulations. They are going to be in great shape. And so it's true, you could have given them a little bit more money that they probably don't need at age 70, but that's not why you saved it. You didn't save all your money up to retire to give to your kids. Maybe you did. People do that, I guess.
Sure.
But I think the problem is that even with that perspective, the risk there is actually not at some kind of like minimum bequest legacy amount at age 75. It's what happens if you live to like age 100. And not only have you used up all your assets, but you're using your kids' assets up as well. And so I think from my perspective, there is obviously time preference here, but I think that for me, it's education. I think that when people talk about bequests and legacy, we need to reframe that and say, hey, if I happen to pass away at 75, I mean, that would be sad, but like, you're going to be in really good shape. You don't have to worry about supporting me. If I live a long time, though, I could deplete all the money that I have and you could depend upon me. And so I think what we need is a reframing of that, where because the truly bad outcome in terms of like wealth effects on children is if you do exhaust your resources and spend theirs versus giving them not as much as you could have had you not bought the annuity. So I think I totally get the perspective. I think it's the wrong way to frame the argument because you're not looking at that kind of true bad outcome for the kids in the grand scheme of things.
Right. So it's an underweighting in the individual's mind of the first circumstance, and your reframing, which I think is brilliant in understanding you're probably going to live longer than you think. And I think most people would have been surprised by, the average 65-year-old woman having a fairly significant chance of reaching 75 and 100. I think in a lot of the viewers will, that doesn't sort of grasp. It's a tomorrow problem, not a today problem, sort of thing. So we're dealing with that behavioral issue as well.
I mean, I think again, it's the key that like I want, it's the relative, utility, if you want to quantify it for each. So like, you're going to be, your kids are going to be just fine if you pass away early in retirement. Like they get all your stuff. They're cool. It's that maybe it's time preference. I don't know what it is, but we focus too much on, like they wouldn't get as much as they could today versus what happens if, things don't go according, if I do live a long time later. I think that is the education that is just lacking in terms of, I mean, like online calculators we have for these issues don't really weigh that or think about that. I think they can lead people to making bad decisions.
I mean, we kind of start our families thinking that way, right? I mean, when we start young and we have children, we think, how can we protect our families? How can we save up enough money? So what if something happens to me? We buy insurance, we do all these other things when we're younger. But as we get to retirement, we're still, we still have this consciousness because our children are still our children, even though they're not children anymore. And we're still thinking, there's still part of us that's still thinking, I want to leave something for them just in case something happens to me or if, if I pass away. But it's kind of, like when you look at the situation right now, it's kind of dreary when you consider that yields are, the 10 years, 1.5, maybe a little bit more. And the, you're looking at an average of 2%, and you consider, what $1 million is anymore. It's not what it used to be. It used to be something if you had $1 million in savings, liquid that you could collect an income from, of 6, 7, 8%, right? That, those days are gone. Now you need 4 times, 2 or 3 times the nest egg that you did just maybe, 5 or 10 years ago. Thanks to our economic situation, thanks to the Fed and interest rates being cut to zero. So like, if investors are looking at bonds and bonds and, in terms of, providing some kind of a retirement backstop of $20,000 per million or $25,000 per million, that doesn't say much for the kind of lifestyle they could have. They're going to be more than likely, I don't know, forgive me, but I don't know what the payouts are on annuities right now. But, if $1 million is paying out $25,000 and your lifestyle is beyond that, you're going to be dipping into your capital to make up for it. And then you have the long, we're right back to where we started this discussion, which is, running out of money before your time.
It's a good point too. Maybe talk about the impact of the zero risk or of the fluctuations of the income on the financial plan as a meaningful sort of input to dampening the risk that you have of that income variability that I think Michael was talking about. So you take the annuity and with a portion of the investments, I think is what you're saying, David. It's not a 0 or 1. So you're going to do some sort of scale. And as you scale up that income that is virtual, it is guaranteed, it is going to come in like clockwork. How does that change the financial plan? Like how much should we be thinking, should investors be thinking and advisors be thinking? Where's the tipping point where you start to see meaningful difference in the overall balance in the financial plan?
Well, I think first of all, what is, again, the preference for income variability of the client? So when you take investment risk because you hope to achieve some kind of a risk premium. You hope to get a better return than you do from bonds. And as Pierre says, interest rates are very low, but that doesn't necessarily mean that stock returns are going to be that much higher. You take the risk because you hope that they'll be higher, but they may not be. They may be lower, in which case you're going to have to cut down your spending. And then your asset allocation really is a function of how much variability you're willing to accept. Now, the way to get rid of variability with safe investments is to pool longevity risk. But when you take market risk, there really is no way to get rid of that variability. It translates directly into the sustainability of your investment portfolio. I want to also address another issue that I know David and I see a lot in the research, which is a lot of people have this corpus mentality where they save their entire life for retirement. They may not even have a very strong bequest motive, but they don't want to see their nest egg get smaller. There's a psychological barrier to seeing their wealth fall in retirement. But that's not rational. That's a psychological problem, because what that means is that they're fixated on that nest egg value as a reference point. And it makes them unhappy to see a value that's lower than their reference point. But then you have to ask yourself, why did you save the money in the first place? What was the purpose of not spending as much when you were younger so that you could build the nest egg if you get to retirement and you don't feel like you can spend out of the nest egg? That's a problem. That's actually something that I think we need to surmount. And I think that actually some financial advisors don't encourage people enough to become more comfortable with seeing their nest egg value get smaller. And in a low asset return environment, the only way that you're going to be able to maintain the lifestyle that you had before retirement is to get comfortable seeing that nest egg get smaller. In order to get comfortable with that, you also have to acknowledge your own mortality, that you're not going to last forever in retirement, that it's okay if you spend the money down, especially if you have, say, plans, set aside some money for your heirs, or you have a life insurance policy. Your goal with the rest of your money is lifestyle. But what happens when you don't feel comfortable spending it? We see this over and over again in the data, that people are not comfortable spending down their savings, but they need to get more comfortable. Now they're not comfortable because of so many uncertainties. And that fear is what drives people to not spend as much as they could. And again, annuitization requires that you have a smaller nest egg. So you might start out with $1 million and you might put $300,000 into an income annuity. That's gone. You now have $700,000. That's a tremendous psychological problem for a lot of people to see that nest egg get smaller. But what it does is it reduces the pressure on the remainder of the portfolio to provide a lifestyle. You don't have to pull as much every year to provide that lifestyle. So you can actually sustain the portfolio for longer if you take a portion of it and you turn it into lifetime income. But I think generally speaking, this is something, especially today in a low return and asset return environment, we've got to become more comfortable with the idea of seeing the nest egg get smaller. Because if we don't, then we're essentially leaving happiness on the table.
I recall, one of my clients, it was a long time ago now, they lived so modestly and they lived in a modest, fairly modest house and modest lifestyle. You wouldn't know that they were worth between $5 and $10 million. and there was no sign of it, and there was no sign of it in their lifestyle. They were, they were getting on. They were getting in, close to their 80s, and they loved traveling, and that was one thing that they loved doing. But they would tell me about their holidays, and it was very economical. They would have a very economical type holiday. They wouldn't stay in hotels. They would rent, sort of more modest accommodation houses, things like that. And one day when they were telling me about this, I said, "Why are you doing that? Why are you living like that? You're not getting any younger." The husband's health was getting poorer. It was starting to show signs. He was starting to show signs of early onset Alzheimer's. And, so I just, out of the blue one day, I said, it's time you started spending some money, because this is ridiculous the way that you're not enjoying your wealth. What did you do it for? What did you work your whole lives for? So you could leave it for your children who, in their case, they couldn't stand, right? There was, I said, this will date it. Take a trip, go to Europe, take the Concorde, right? When fly first class. Don't ever fly economy ever again. Fly first. Get a chauffeured drive from the airport to wherever you're going. If you're going on a cruise, take a first class. Take the highest class stateroom you can get, since you love cruising, or rent the most luxurious accommodations you're comfortable renting. And they did it. They did it. They actually took a trip to Europe on the Concorde, and continued, from there to Japan.
And that's
Europe.
when you became a travel agent.
And exactly. But wait, this is about a year later, and it's kind of sad. It's sad because I really I loved them. Like you get really into your clients' lives when you're an advisor. And about a year later, the husband's health deteriorated significantly, and the Alzheimer's came full on, and it was impossible for them to get away like they used to. But she, that year, that quarter, she came in when things were not going well, and then I think the year after that, the following year, he passed away. But she came and she thanked me. She couldn't believe, how right that was for them to do it once and for all. That's something that they had never done in their 50 years of marriage. Something that never occurred to them. Let's enjoy our own money, our own wealth. And so your point about, getting used to seeing your nest egg depleting, not depleted, but was a great point, that people sit there and there's this risk that they could become miserly about, their lifestyle versus the numbers they see on their statements.
Well, I think the way you put it, Michael, was really succinct, right? It's this trade-off of you have this constant fear maybe with your investment account, because you've lived through a lot of times the clients you're referring to, Pierre, they have lived through the Great Depression. They were World War II babies, right? So those clients in particular, once they have a nest egg, they are very fearful from a mental perspective of that being something that's hard to come by. And here you can take part of that and know that it's not gone because the market took it away, or let's say the stock market in this case, but it's gone because it's going to create that steady flow of income where you can literally always buy whatever that travel is that you're wanting, or whatever that lifestyle increase that you would like to have a regular occurrence of, and not worry about the fluctuation of the underlying markets themselves. Is that kind of, I mean, you've already stated it as well as it could be stated. So,
Concord.
I also wonder, what are the implications on sort of some of the old, rule of thumb, 4% type, commentary we see out there. I think there's something that's got to be twisting in the wind on that, given valuations and starting yields. Well, what are your thoughts? What comes from the high levels of financial planning with these 4% rule of thumbs and things like that?
Michael, you did a good job of not convulsing there when he quoted the banking rules. So Your
So, I mean, Michael and I might disagree on this. Okay. So this is one where there could be, I'm actually not sure. We'll see how this goes, but people, Michael and I and Wade and a ton of other folks have rerun the Bingen analysis, which at the time was amazing. It still is, using more realistic returns, right? Like bonds, you can't get 5.5% for bonds. You run it at 1.5%, 2%. Okay. And so, the number's a lot lower, right? So the number goes from, 4% to 3%, whatever it is. But I still think that 4% is an excellent starting point for most people, right? You can even take out 5%, right? Because a problem with that analysis and the rules that we use in general is it assumes that, oh my God, I'm not going to change my withdrawal amount for 30 years, no matter what. It assumes that if I go broke, that I'm destitute, right? In reality, the portfolio for most retirees is a marginal source of income. It's on top of something else, right? In reality, just because you don't meet a goal exactly doesn't mean that it wasn't a great strategy. So I actually think that 4% is still a great place to start with those caveats. If you think about what it means to retire and fund retirement. Now, what it would have been, if we can use historical long-term averages, is like 5 or 6%, right? I think that actually even like a nominal initial withdrawal amount is a good place to start because people tend to not increase their spending by inflation. So then 5% is realistic. So I think that the key here is context. I mean, to the earlier conversation, one thing that I do worry about is that a lot of advisors don't consider additional guaranteed income, aka annuities. And so they say, oh, Mr. and Mrs. Client, you've got low returns. You're going to live until you're 100. So, to be safe, you shouldn't spend any money. Well, that's not the right perspective. The perspective should be, how do you take that pool of money and maximize income? And it is challenging today, but unless you kind of think about what's wrong with the models we use, you're not going to get the right, outcomes from those models. I'd be curious if Michael agrees or disagrees with me.
Well, I think a lot of what motivated us at the beginning to start questioning this is because many advisors were saying, why would I ever consider buying guaranteed income, especially at today's rates, when I can get 4% adjusted for inflation every year from a balanced investment portfolio? And we're saying, whoa, that's not necessarily true, because we know that the fixed income component of the portfolio is far below the historical average. You're only using historical US data. Wade made the point that if you used international data, that safe withdrawal rate would have been closer to about 3%. And then you're left with this, well, maybe it should be 2 3/4 or 3%. To which we say, no, that's not the conclusion that we hoped you would draw. The conclusion we'd hope you get is that you would consider what your goals are, and then, building guaranteed income with the bond portion of your investment portfolio, creating a base of income that gives you a bigger safety net, so that if you do run out of your savings, then it's okay if you're 85 years old and you're living on, $50,000 a year or something. That's not the end of the world. And in fact, what ends up happening is that people very often spend the most between 65 and 75. And that's when you should spend the most, because that's when you're most physically capable of getting the greatest amount of enjoyment from your money, and you're most cognitively capable of getting the most enjoyment out of your money. So I don't want to tell anybody not to spend their money between 65 and 75. I want to tell them to be realistic about the risks that you face and the goals that you have, and building a combination of an investment and product strategy that's going to do a better job of helping your clients be happy in retirement. So that whole idea of only focusing on the investment portfolio and only focusing on the amount that you can withdraw from the investment portfolio adjusted for inflation over a certain number of years, that's probably not the frame of reference that I want to encourage advisors to use. I want to encourage them to be a little bit more flexible about what their alternatives are.
Is there a problem with do you find there's a problem with advisors maybe not accepting the capital market assumptions going forward? When they're doing their planning, when they're doing their investment planning?
So one concern that I have is how you incorporate capital market assumptions, right? So I have a pretty high level of certainty. If you buy a 10-year government bond today, the yield is 1.5%. I feel really good about that, right? We know that. I don't know what they're going to be 10 years from now. I don't know they're going to be 20 years from now, right? And so I think that it is important to be aware of today's return environment, but it's important to also incorporate it correctly into a financial plan. Now, maybe you think that this is the new normal, and that's totally possible. But, most people that create different, sets of CMAs have like a near term low value and then some kind of like higher eventual more unconditional value. And so I think that when advisors should kind of think about return assumptions, it should be multi-period. And what I worry is that, you're going to use, again, if you think that they're low returns, that's fine. But that, I think that context there is important. And I don't know that a lot of tools allow for that, but I'm a big believer in assuming that like returns are low for the next, you can pick a number, 5, 7, 10, 12 years, then they're going to be higher at some point in the future. And why that's just so important is, if I'm at retirement, then the low returns right now are really, really important. Okay. If I'm 25 years old, it just doesn't matter because returns when I'm, 40 years from now are really important. So I think that like the CMAs are super important, but the context is too, because, these plans can last for 70 plus years. And all we really know about is where yields are right now.
Well,
one of the
so
things that
much
really
is
scares
dependent on
me is all the people that are retiring right now. We are on the tail end of one of the longest bull runs in the asset market in history. And what you see is this sort of avalanche of people in their early 60s saying, I met my nominal dollar threshold, I'm going to be okay. That scares me a lot. And I know Adam, you and I sort of agree about the direction of asset returns in the future. And one of the things that scares me about assuming historical asset returns is that it can actually induce people to retire earlier than it's safe, earlier than they can generate the lifestyle they want to live.
There's something else too, that the idea of delaying retirement as being a very powerful lever to accomplishing retirement goals too. As part of that, so you've got this almost perfect setup for Mr. Market to have a whole bunch of baby boomers, this massive population. We reach peak 60-40, yields are low, discounted cash flow assets prices are high. A whole generation now feels like they can retire, put their feet up and relax, only to have the rug pulled out from under them over the next decade, potentially. So there's that one should think about for sure. But in the case where one experiences something like that, they're looking at retirement and they either have a drawdown they didn't expect. Can you guys elaborate on how delaying retirement or taking it a year earlier really has this potentially large impact on the potential outcome over time? Or does it?
So, I mean, it does. Delaying retirement is like the single best thing that you can do to improve your outcome. For the US, you get an additional year to save, you got additional year delayed credit for Social Security, your assets can grow a year, you got one less year to plan for. It's amazing. Okay. My concern with delayed retirement is that it's often used as this plug in a financial plan. Oh, you're not on track to retire at 62. Just work till you're 70. Well, that isn't reality. There's still a huge gap in actual, there's about a 4-year gap on average between expectations and reality. And so I think too often planners use delayed retirement as this plug. Oh, you'll keep working longer. Well, that doesn't actually happen, right? So yes, I totally agree that delayed retirement is good. And I think to Michael's point earlier, like a point I'd make right now is that if you exit the workforce, now's a little bit different than normal. Like your ability to re-enter the workforce and get a good job isn't very good. So, if you can just, maybe you hit that goal, but hang on for a few more years until you're absolutely done. That way, if something bad does happen, you're in better shape, because once you're out, it's hard to get back in. If you're in and bad things happen, you're still in the workforce. So the one caution I always give is like, when you pull that trigger, that's a pretty big decision. And again, I think given where unemployment is, it might be easier to return now than it was before, but still your job prospects when you're 65 are better than when you're 75, but they're still not great.
One of the, I think, points of confusion for many advisors and retirees, they believe that, for example, the Great Depression was the period of time where it would have been hardest to retire, right? If you sort of retired into 1927, 1928, 1929, and endured the Great Depression, and were withdrawing funds over that period, that would have been the most challenging time. And in fact, when you go back through history, perhaps the most challenging time is actually from, if you sort of were to retire at about 1966, and then you were to endure both the low return environment of the late 60s and 1970s, combined with this major uptick in unexpected inflation, right? So you've got low returns and a faster than expected erosion in your purchasing power. We haven't seen inflation like that in a very long time. And there's very few people that are able to draw on personal experience to inform expectations there. Are you guys worried about that? I mean, just looking at some of the potential signs of inflation here, but I mean, notwithstanding any sort of macro call here, do you think that investors are prepared for a higher than expected inflation rate here? And if not, how can they close the gap, do you think?
Adam, I mean, you're basically describing today. So, I mean, it looks like we're going to have a low return environment. Inflation's going up. If you're on a fixed income, if you have finite amounts of assets, it means that you deplete faster. It means your actual lifestyle is worse. It's a risk that I don't think we know how to deal with right now. I mean, our Social Security is inflation adjusted, which means that part of your base income is going to go up if inflation rises. That's a good hedge against inflation. Everything else, it's hard, other than assets that are specifically tied to the inflation in the price index that most closely relates to what you spend money on in retirement. Unless you can buy assets like that, then it becomes kind of a crapshoot in terms of what assets are really going to correlate most strongly with inflation. And you're right. As soon as you were making that point about what the worst time to retire was, I was thinking, 1966. Like that is the time that most resembles today and was really the worst time because the cost of funding your lifestyle is rocketing up at the same time your investment portfolio is stagnating or falling. And the worst case scenario would be a situation where there is a drop in asset prices at the same time that consumer prices are going up. And that's a risk that nobody who is in retirement right now has ever had to face something quite like that in the past. And a lot of financial advisors, especially, have a difficult time conceptualizing what that would look like. And I know a lot of economists have been saying for a long time that focus on inflation. It's a risk. I know it hasn't reared its head in a long time, but it's a risk. It's happened historically. It's real. You got to think about it. But the problem is that assets that hedge inflation are so expensive right now. To buy a treasury investment or a bond investment that is inflation adjusted locks you into a 100% certain loss in purchasing power. For example, for every $1,000 invested, you will have, say, $935 of purchasing power in 5 years. That's the safe route, is that your purchasing power is going to decline certainly over the course of 5 or 10 years. So it's an insurance policy, but you're going to live worse. And your alternative is to say, I'm not going to hedge that risk, but that means that it could get even worse than that. It's depressing.
Yeah.
There's just one way to do it.
Well, what always strikes me is that it's not as though there are no asset classes or investment options that are designed to hedge certain types of inflation, right? It's just that they are hard to price. They're unconventional. They manifest in large tracking error to core benchmarks. The elephant in the room, to my mind, is commodities and gold. I mean, there's also, if you're an institution, you can buy inflation swaps, that sort of stuff. But, I understand psychologically why investors don't hold a lot of commodities and gold in the portfolio because they've been a major drag on performance over the last decade. But for planners, like for people in your serving your role, how come you guys haven't given more thought to, what it looks like to add explicit inflation hedges in the portfolio, what that might look like and how people should approach it?
So, I've actually looked at that exact topic, right? So your point is spot. From my perspective, like the marginal efficiency of commodities type asset classes is low for someone who is younger because you have implicit inflation hedges within your human capital or other means. The value of that exposure of commodities, of tips, of real estate increase significantly for individuals who are in retirement. And so an efficient retirement portfolio for the same, you could say, generalized risk level, however you want to define it, should look very different, or at least a little bit different than the efficient accumulation portfolio, because the underlying assets of the household have changed, as has the nature of the liability. So I'm a big believer in having, different, or again, very different exposures for a retirement focused portfolio, and one that is geared towards accumulation.
And then how do you model that?
Well, there are different ways you can do it. My preferred method is a resampled portfolio optimization using a utility function to determine the surplus variance in the outcome.
Okay, but then in the context of these inflation hedges, right, you've got to then
you have
use
to have
some
assumptions,
sort of
right?
assumptions.
And so I have, luckily, people that I work with that are smarter than me, have done lots of work on different asset classes. You have to resample it, right? Because no one knows what's going to happen. You could even do a generalized 1/n. I'm not opposed to that. I think the key is just having some of it in a portfolio. I mean, those of us that spend time on this, we debate should it be 20% or 24%, when I think the bigger question is just having it and not worrying so much about what is that weight.
Yeah, not zero.
It's not zero. That's right. Well, I mean, the thing is, it can be zero. I mean, again, I think it's moving away from just pure mean variance optimization to say, hey, this portfolio exists and it's not an island. There's other stuff that exists out there, and it exists to fund a goal. And so when you reframe a portfolio into this more holistic setting, it can radically change the definition of what is a truly efficient portfolio for a household or any investor. For an endowment, endowments have donation risk. I mean, or a charity, the largest asset for most charities is the net present value of future donation. And so there's all these other things that matter when it comes to building portfolios that I think that the vast majority of folks don't think about. They just like a nice handy little mean variance optimization they call it a day.
So what would the sort of top 3 takeaways be for an advisor who wants to get closer to the current understanding of kind of best practices for retirement planning, right? Where are the 2 points that are probably the biggest delta between how people typically approach the problem and an optimal way to approach the problem, given all of the things that we've learned over the last few decades about this challenge?
Well, I think I'll just step in and say step 1 is that this, a lot of advisors focus on the accounts. They practice account-based advising as opposed to goal-based advising. So sitting down with a client, asking them what they want to achieve with their money, how much do they want to pass on, how much do they want to spend, how much spending flexibility are they willing to accept, and then build a strategy around their goals, rather than just looking at their investment portfolio and doing a risk tolerance test and estimating an optimal percentage of stocks and bonds, fiddling with some tax efficiency. That's not it. What's it is sitting down and asking your client what they hope to achieve in retirement, and then building the strategy around the goals rather than around the account.
Great. Yep. That's one.
I mean, that tends to be because that account may be the extent of all the assets they have from that particular client, right?
What? Are you saying that advisors base their advice sometimes on what they're managing? I don't
These
think
fiduciary advisors.
Yeah.
What?
These
So I would say as a
best
follow-up,
interest
I mean, Michael will, I think, agree with this one spot on, is education for advisors, I think, is absolutely essential. I think that, when you move towards this context of goals-based investing, you have to understand how all these different things work. And I am so tired of these excuses advisors give about, oh, annuities are expensive. It is your job to know this stuff, right? It is your job. You have specific human capital in helping clients accomplish their financial goals. You should be an expert on all the different vehicles, tools, strategies, solutions, options, whatever you want to call it out there that they can use. Now, they're not going to, some might not work for all clients, but some will work for a lot. And I think that that's what advisors need to be doing. And, if I'm a retiree listening, or a near retiree, and the only thing that my advisor talks about is a stock and bond portfolio, that's not necessarily the right advisor, in my opinion, for someone. I want someone who's thinking about all the options holistically because they're educated on them, and then coming up with a plan based upon that.
So what are some good tools that advisors can turn to put some of these best practices to work? Many independent RIAs, obviously, they don't have firm-based software or tools. So they're going to be looking to outsource some of this to technology, et cetera. I mean, obviously there's a garbage in, garbage out problem, right? A lot of software suites probably are not targeting, maximizing marginal propensity to spend, or, the marginal utility of excess spending, or relative to the variance of the corpus. Like, what are some of the most usable or approachable tech stacks in this space relative to their actual efficacy and actually approximating best practices, in your opinion?
I don't know. I mean, to be honest, I'm rusty on the tools that exist. I think to one of your points is I'm increasingly concerned about the metric that almost every tool uses, which is success rates, right? So we've moved to a world where advisors are running Monte Carlo simulations, and Monte Carlo is just a sample word, is just a fun word to say that there's some randomness tossed in there. Okay, well, the only random variable is returns. And there's a lot more random stuff that can happen in retirement than returns, like when you actually retire, when you die, lots of other stuff. Okay. On top of that, right, if success rate is the outcome, so it's binary, yes or no for each individual run, that can give very bad answers for decisions around things like guaranteed income based upon all the other assumptions. And so, I believe in financial planning tools, but a lot of them, assume a static strategy where you make a bunch of decisions when you retire, you don't revisit it. And I think planning is always a good thing. I'm just increasingly jaded on the way that most tools that exist do it, at least today.
When I started out as an advisor, my mentors really were very negative on things like whole life insurance and insurance products in general, other than term life, of course. The trick in that time was to, if a client had a whole life policy, was to convert them to term and take the policy value and invest it in, in the market, in funds, or, in a portfolio. But, so very early on, I mean, there was a very strong bias. I think, I'm not saying it was just with me. I think it was across the industry in terms of the independent advisors, not the insurance people, but independent advisors versus the insurance advisors. And, insurance advisors tended to recommend things like whole life because, that was their equivalent of a portfolio. And I'm talking in the, late 80s, 90s now. But, so I always had a bias. I always had a personal bias against these ideas. First of all, before I go on, I couldn't agree more with you. I think it is an advisor's responsibility to know what all these options are, including annuities and how they work and whether or not they should be part of a client's financial picture. But, you have to overcome that bias. There was a really strong, in Canada, I don't know if that applies in the US as much, but there was a really strong bias against recommending, insurance-based investment products or annuities or those types of instruments when you could actually capture those assets for your own business. And, there was a sales motivation, obviously, as well in there. It wasn't strictly that, we were all functioning like fiduciaries in those times. But, when the business is very transactional, you tend to, on the advisory side, you tend to, if you've been in the business, if you've been in and around the business for as long as some of us have, you remember those times and you remember the bias. And I think maybe that's part of the problem is that, when you go to talk to annuities, when you go to speak about annuities to your clients, you have to be on board first. And so you have to overcome that bias.
I think that's the point that David and Michael are making, is that it's not your goals.
Yeah.
It's not your sales goals that we're talking about when we're talking about goals-based planning. Right.
Are you sure? Are you?
Those aren't the goals that we're trying to reach, just so we're all clear. I mean, David, you mentioned a couple times annuities being expensive. In Canada, they're one of the cheapest things you can buy. They are less expensive than term insurance. Like the commission built into an annuity is almost nothing in Canada. You really get like full flow through of the dollar that people would invest in an annuity. And yet, we don't have a lot of adoption. And like you said, if you're managing $1 million and you're managing that at 1% MER, you've just given up 30% of your revenue. If you're going to take $300K and you got the sum total of, a half of a year's revenue that's gone forever. And so it's unlikely that, this is a hard thing to say, but it's unlikely that, from on high, from sales management on down, that's going to be a highly recommended, item in the docket, unless you're, maybe a fee-based planner, from that perspective. And there's a bunch of challenges with just the fee-based side. But anyway, the goals-based stuff is great. The tools, I guess we'll have to find some tools for everybody to.
Well, as a guy who's built, 5 or 6 retirement simulators over the years and attempted to, do the joint probability distribution of the longevity risk and the market risk, and then realizing that really nobody cares. One of my favorite stories is having a really thoughtful planner at one of the firms we used to work at. And he had some of the most advanced tech operating under best practices, use a joint stochastic model, realistic capital market assumptions, et cetera. And, develop these really thoughtful reports, and the advisors universally despising them because they produced expected cash flows that were far below the expected cash flows that were being touted by their peers. They're competing for business. They're being responsible and prudent. The income that they're suggesting the retiree can pull is considerably lower because they're using stochastic models than the other advisors here who are using linear expectations. And the advisors universally just wanted the, 45 pages of pro forma expected cash flows out for 400 years using linear assumptions. And I mean, it's just, I in your experience, are these competing priorities still existent today, or is the investment industry becoming a little bit more enlightened in its maturity?
Still a problem.
It's something we've struggled with for so long.
But I'm to your point. What is the incentive for the advisor? I mean, Michael and I are like phenomenally depressing. You get us on like a tag team presentation about like capital market assumptions, we're gonna make you cry. Okay, what is the vested interest? No one makes an advisor use whatever assumptions they want to use, right? How many advisors do you think that get CMAs take their fees out of those CMAs? Right?
Well, no, they have the alpha.
No. The alpha would come from the investments, right? I'm not talking about the investment expenses, right? Yeah. So like technically, right, like the ETF will assume that, I'm just saying the advisor's costs aren't the alpha component, they can add it back in. What they should say is, hey, I charge 1%. That's going to come out of these returns directly. Yeah. I'm going to add, but no, they don't, no one does. These are things that advisors aren't doing because what's the benefit to doing so? Like, you can use our incredibly depressing return assumptions and then your clients cry and they go to a different advisor who can say, hey, you're going to be fine. Right. Yep. And I don't know how you educate past that to most people that aren't like robots, like economists.
Yeah, I think that's the problem, right? I love that there was this great piece from Alan Greenspan when he was a disciple of Ayn Rand. And it was it was his paper on regulation. That, there was no incentive for somebody, for example, and I had this conversation, I remember once with an electrician who was bitching to me about, the shitty standards in the electrical industry, right? There was no incentive to do great work because, you weren't going to get paid more than the next guy to do amazing electrical work, right? So you could be the best electrician with the highest standard, the highest operating standard. And yeah, that would go to your reputation ultimately. But in the short run, there was no incentive to, if somebody came along and did the same work, the same kind of work, but lower quality, there was no incentive to be better than the average. And I think that's the problem that we see here that we're talking about, is that, advisors get these, very high tech construction, portfolio construction models and capital market assumptions. And then the moment somebody comes along to threaten that whole thing, like, David, like the guy you said, oh, everything's going to be okay. There's no need to worry. That advisor gets the business, but the advisor who spent, hours preparing for a meeting, hours preparing, capital market assumptions and putting a model portfolio together for a particular client is faced with, what does this mean? What is that? I don't understand. Just get me there. and then, I think that's part of the problem. So I'm not saying that people are going to, I'm not suggesting people are going to stop doing great work. But if it's like, I remember going, for example, going to Venice, supposedly there's great restaurants there, right? But when you walk around Venice, all there is pizza and pasta, right? And tourists, that the reason there isn't, tons of fine Italian restaurants in Venice is because tourists want pizza and pasta, right? So what's the incentive? I mean, there are some great restaurants in Venice, but what's the incentive, to compete against every mom and pop pizza and pasta shop in Venice when that's who's making money and the restaurants are sitting empty half the time. And so I think, that's the dilemma that we're talking about here, right? Is that there are lots of amazing options, lots of better options for retirees, for investors, along the lines of some of the stuff we've been talking about today, that are superior to, the portfolio. But then when you match that up with what's in it for the advisor and what's in it for the client, there's a mismatch there, clearly.
Well, this is a problem with any expert service industry, that you know more than the client does. And so the client doesn't have the skill to evaluate the advice that you're giving. They just have to sort of trust you. And they go on feeling. And sometimes the feeling is accurate and sometimes the feeling is not. And so giving people negative information can create a negative feeling. So they don't want to see you. And I guess the trick is, for someone who is trying to be a realistic advisor, how do you allow people to have a positive feeling about the experience of working with you while still being realistic? So, and to that end, I really do think that following a more goals-based approach, because when you focus only on the portfolio, then you judge your advisor based on what happens in the portfolio. You become a portfolio-centric advisor. If you're a goal-based advisor, then the advisor can ask you questions about your life. They can show that they understand what you want to achieve. They can get to know you deeply in a personal way that you can't if you're only a portfolio-based advisor. So my answer is, like, if you are an investments only advisor and you're only focusing on the portfolio and you're giving bad news, you're creating a negative feeling. And the client's going to walk away trying to find another advisor that's going to make them feel better. But if you follow a goal-based approach that incorporates being realistic, but gives your client a positive feeling because they feel like you understand them, that's an alternative to the only value proposition being the investment performance.
But Michael, aren't all advisors goal-based advisors and active listeners and hand holders and nurturers of their clients? Aren't they all?
The good ones are, and I think that we're joking about it, and a lot of people are just incredibly bad about it. But
I'm surprised. I I've always gone on the assumption that that was just good practice, that was just a good baseline practice, which was actually to ask your clients what they want and then find a way to solve that problem.
And by the way, sometimes some of them just want an investment-based advisor.
Yeah.
So this is not to
Yep.
I think,
there's the other side, right? That's the other side of the coin.
Advisors. If you have a particular practice, as long as you're real about it and someone comes to you for financial planning advice, you say, well, that's not my gig. That no one can hold,
Absolutely, Mike. I totally agree with that. There's obviously there's people who want to just invest their money and they don't want to get into a whole diatribe about their life and their goals.
Yep.
So that's the other side, right? Not everybody wants to lay it all out on the table with a new stranger.
Agree. Again, I think that comes back to good initial listening, though. I mean, if you're that type of advisor looking for that type of client, and you guys meet and you have a meeting of the minds, then way you go. It's a free market. Knock yourselves out. Anyway, we've had you guys for over an hour. Is there anything that we didn't cover that you wanted to make us aware of, or anything that we missed along the way? Adam, did you have any other questions or comments that you wanted to?
I don't. I just want to make sure that people know where to find more from David and Michael. Where can they find you? Where can they find your work? What are you working on right now and excited about that people should keep their eyes peeled for?
Well, David, you have your own website, correct? Where you have all of your publications?
I do. So if you want to learn more about me, I would recommend I have a website. It's not very good, but it's informative. davidandblanchett.com. I'm also somewhat active on LinkedIn as long as my compliance allows me to do so.
And we both write for Advisor Perspectives, which is a newsletter for advisors. It's online. And you can also find our research on Social Science Research Network, which is ssrn.com. Just search for our names and you'll see our publications.
Awesome. We'll be sure to put those links and anything juicy that we find in the show notes.
I love it.
Thanks so much, guys. This has been exceptional, as I knew it would be.
Yeah.
And
absolutely.
Thanks for all the amazing contributions, and we look forward to next time.
Cool.
Yeah. One last question. Would you rather spend a week in the past or a week in the future?
Whoa.
Do I get to come back to the present if I spend it in the future?
Well, you're just going for a week, right?
But I got to come back, right?
Correct.
Yeah, it's like a holiday, but you get to go to either the past or the future.
Do we get to choose which week in the past, or is it random? Is it stochastic weeks? Or stochastic weeks in the future?
And can we do it with this option now? Like, can I hold on to this and use it later? Because at this point, I would pick the future, but I can assure you, I'm sure at some point I'd pick the past based upon things that have happened.
There you go.
In other words, don't ask us that question.
I love it. It's any week in any future or your future or your past.
Well, we could do non-disclosure agreements if you want.
I do think we tend to be more optimistic about the future. So most people would probably choose the future than the past.
I love it.
I know that I would eventually choose the past at some point later in my life. I'm sure there's a week that I will look back on and want to relive that with anything else.
Yeah, I'm
not
older
there
than
yet.
You are too. So my future.
You're really old. So I would say at this point, the future, but the older I get, the certainty will increase dramatically that it would be the past.
I love that.
So it wouldn't be back.
That's a good answer.
It wouldn't be back to the future. It would be forward to the
Forward
past.
to the past.
Yeah.
Yeah.
I love it.
All right.
Yeah.
Thank you
Awesome.
very much, guys.
Thank you, gentlemen. That was
Our pleasure.
awesome.